Welcome everyone to Chart Pattern Essentials Trade with Confidence. My name is Ali Mortazavi and I'm the Head of Training and Education at Errante. Today, I'm thrilled to guide you through the nuanced world of chart patterns where we'll unlock the secrets to trading with a more informed and confident approach. In this webinar, we will delve into the fundamental patterns and emerge from the movements of the markets, understand their significance, and learn how to leverage them in crafting robust trading strategies. Whether you're a beginner looking to get a solid start or a seasoned trader aiming to refine your techniques, this session is designed to provide valuable insights for you. And without any further ado, let's embark on this journey of discovery where each pattern we explore will bring us one step closer to trading with confidence and come from knowledge and expertise. So welcome aboard. Let's take a moment to introduce Errante, an online broker that prides itself on offering premium services to all traders. At the heart of Errante's mission is the commitment to fostering robust and enduring relationships with clients and partners alike, and this commitment to excellence is woven into the very fabric of their operations, ensuring that every interaction with Errante is not just a transaction, but a step towards a long-standing partnership. But before we proceed, let's acknowledge the importance of due diligence. Please be informed that all the content that we are providing during our webinars, all the examples, strategies, please don't take them as investment advice, and these are all solely for educational purposes because CFD products are really risky. So you need to do your own due diligence before entering any trade, and it mostly depends on your capital, on your risk tolerance, and also your knowledge about the financial markets. As we embark on this educational journey, let's outline the key outcomes we aim to achieve through this webinar on chart patterns essentials trade with confidence. Firstly, we will delve into the chart patterns in trading technical analysis, where we will explore foundational tools and techniques to identify market structure using chart patterns, and this knowledge is essential for understanding how market prices move in a way that can be anticipated and acted upon. Next, we will discuss chart patterns in relation to general market patterns. Here, we will learn to capitalize on reversal patterns based on the general rule of market movement and the formation of primary trends, empowering you to make more informed decisions in your trading. Then we will examine the common features of chart patterns. You will grasp the types and identification methods of chart patterns and learn how to trade with them, and invaluable skill in navigating the markets. Moving forward, we'll focus on mastering different bullish and bearish reversal patterns. This will involve gaining expertise in identifying and interpreting the most common and reliable reversal patterns so you can better time your market entries and exits. And finally, we will conclude with an interactive Q&A session. This is where you can engage directly with the material, ask questions, and deepen your understanding of chart patterns. It's your opportunity to clarify complex concepts and apply the learned principles in various trading scenarios. By the end of this webinar, you will be equipped with a comprehensive understanding of chart patterns, providing you with the confidence to apply these techniques to your trading strategy. So let's begin this transformative learning experience together. Okay, welcome again to our review of the fundamental principles of technical analysis and essential toolkits for any trader in the financial markets. Today, we'll focus on understanding the underlying logic that validates the use of chart patterns as indicators for future price movements. Firstly, let's consider the principle that markets are always moving in trend. technical analysis observed that markets move in identifiable trends which, once established, tend to persist for a period of time. These trends are the foundation upon which technical analysis is built, as they help traders to anticipate future market movements by examining the direction and the strength of past and current trends. Next, we embrace the concept that everything is included in the price. This principle posits that all known market information, be it economic data, political events, or mass psychology, is already reflected in the market price. So prices move in patterns that are not random, and these patterns are driven by a multitude of factors, including human emotions and market perceptions. Lastly, and most critically, we come to the principle that uh, previous valid patterns are valid in the future as well. This is a cornerstone of technical analysis grounded in the belief that market history tends to repeat itself. The patterns we observe in price charts represent the collective actions and behaviors of market participants. Because human behavior tends to be consistent over time, these chart patterns and trends become predictive tools. When a particular pattern is consistently preceded a certain market move, it becomes a valid template for future predictions. Why do these patterns repeat? That's a big question. Uh, However, one of the simplest answers is that it's largely due to the psychology of investors and traders. Fear, greed, hope, and other emotions that drive market behavior tend to manifest in similar ways over time, creating recognizable patterns in price charts. By studying these patterns, technical analysts aim to identify opportunities where the likelihood of a particular market move is high based on historical precedent. In this context, chart patterns are not just lines on a graph, they are reflections of market sentiment and behavior. When we identify formations such as a head and shoulders, for example, or a double bottom, we are not just seeing a random shape, we are witnessing the narrative of market psychology unfold in real time. These patterns give us insight into the collective mindset of the market and allow us to make educated predictions about future price movements. Understanding the principles of technical analysis empowers us to use chart patterns not as guarantees, but as tools with proven efficacy. They are the language through which the market communicates past behaviors and potential future directions. So, as technical analysts, our job is to become fluent in this language and interpreting the signals and making informed decisions in our trading strategies. Today, we are going to focus on one of the key concepts that every trader must master: chart patterns. Chart patterns are essential tool in technical analysis, as we explained. Firstly, let's talk about reversal patterns. These are the formation that suggest an impending shift in the market's direction. When you spot a reversal pattern on the chart, it's an indication that the current trend may be nearing its end and the market could be about to change course. These patterns are critical for traders looking to capture profits at the optimal moments by anticipating potential market turns. Some classic examples of reversal patterns include the head and shoulders, double and triple tops or bottoms, and various harmonic patterns. Today, we will delve deeper into these reversals. Yep. Uh, we will explore how they form, what they signify, and how you can use them to make informed trading decisions. Understanding these patterns can give you a significant edge in identifying prime entry and exit points, while continuation patterns and bilateral patterns are also integral parts of chart pattern and analysis, indicating pauses in trends and indecision in the market, respectively. We will cover these different patterns in our upcoming webinars for sure, but today our focus remains on the reversal patterns, which signal a potential change in market trends and a shift in market sentiment. Understanding reversal patterns is not just about recognizing the shape of the chart, it's also about grasping the underlying market dynamics and lead to the formation of these patterns. It's the psychology of market participants fueled by their fears, greed, and collective decision making that we read through these patterns. Remember, the ability to identify and interpret reversal patterns can be a game changer in your trading strategy. So let's move forward as we continue our exploration of market dynamics. It's crucial to understand the pattern of the main trends movements. Here we see the three distinct stages of a primary market movement as articulated by Charles Daw, the, let's say, father of technical analysis, and everyone knows him, and how reversal patterns fit into this framework is essential to know. The first stage is the initial momentum aggregation. During this phase, informed investors, often referred to as a smart money, begin to recognize a potential shift in market fundamentals, and this stage sets the foundation of a new trend. Although it's not yet obvious to the general public, the price action here is typically more gradual, and this is where early reversal patterns can first emerge. We usually trying to find, let's say, bullish reversal patterns at this stage. These patterns here can signify that the market may be starting to lose its trend and start, let's say, a new trend. And then moving to the second stage, we have general participation. This is where the trend gathers full strength and becomes evident to the wider market. Retail investors join in, news outlets start reporting on it, and the trend is at its most powerful stage. It's characterized by the highest volume and the most significant price movements. Reversals are less common in this phase as the momentum is still building and the general sentiment is still strongly in favor of the prevailing trend. The third and final stage is dispersion of forces here. The trend matures and the smart money begins to take profits, leading to a reduction in momentum. It's a critical juncture where the market reassesses the price and reversal patterns are most pronounced. Traders watch closely for these patterns as they indicate that the trend could be running out of steam and a significant reversal is possible. Understanding where reversals typically occur in these three phases is key to effective trading. In stages 1 and 3, where momentum is aggregating or reducing, traders must be attentive for early signs of a reversal. The psychological interpretation here is vital. As sentiment shifts, so does the likelihood of a reversal. By recognizing these patterns and understanding the psychological drivers behind them, traders can make informed decisions about when to enter or exit the market. In summary, knowing the stages of a primary market trends helps traders to pinpoint potential reversals. It's not just about reading the charts, it's about understanding the market psychology that drives these movements and using the knowledge to anticipate changes before they become obvious to all. Okay, so far so good, guys. Very well. Uh, okay, let's continue. As traders, one of the most critical skills we can develop is the ability to identify trend reversals. These insights can help us capitalize on shifts in market momentum, allowing us to enter or exit trades at optimal points. Today's discussion will walk us through the three fundamental levels of identifying a reversal pattern. Level 1, existence of previous trends. The first step is to establish that there is a trend in place to reverse. Without a prior trend, there cannot be a reversal, okay? Actually, bearish reversal patterns typically form at the ends of an uptrend, signaling a potential move downwards. Conversely, bullish reversal patterns are found at the conclusion of a downtrend, indicating a possible upward trajectory. So recognizing these trends is pivotal. It sets the stage for a change. And then the level 2 is reducing momentum. Once we've identified the trend, we need to observe momentum. In bullish patterns, if sellers can't push the market to new lows, it suggests that the downward momentum is fading and a trend reversal to the upside may be imminent. Similarly, in bearish patterns, if buyers are failing to achieve new highs, it implies that the upward momentum is waning and a downward trend reversal could be on the horizon. This reduction in momentum is a key signal that the current trend is losing strength and a reversal is becoming more likely. And finally, we have the level 3, breaking down key levels. The final level is confirmation. For a bullish reversal to be confirmed, we must see prices breaking through a key resistance level. And it's the definitive sign that the market sentiment has shifted and buyers are now in control. For a bearish reversal, the opposite is true. Confirmation comes when prices fall below a significant support level, indicating that sellers have taken the reins and a downtrend is likely to ensue. So each of these levels builds upon the previous one, forming a structured approach to identifying potential reversals. And it's important to note, by the way, that while these levels can provide strong indications of a trend reversal, they are most effective when used in conjunction with other technical indicators such as moving averages, stochastic RSI, or MACD to confirm the change in market sentiment. By systematically evaluating these levels, traders can enhance their ability to discern and act upon potential reversal patterns, thereby adding a powerful tool to their trading arsenal. Remember, the art of trading is not just in predicting the future, but in managing risk by recognizing the responding to cue signals that the market provides. However, let's keep it for a while, and now we're going to explore some of the most popular bearish reversal chart patterns that every forex trader should be familiar with. The head and shoulders, double top, triple top, and maybe one of the most reliable on but a bit overlooked one, a bearish failure and non-failure swing patterns. Each of these patterns signals potential selling opportunities as they indicate the end of an uptrend and the start of a downtrend. Let's start with the head and shoulders pattern, characterized by three peaks, with the middle peak being the highest, as you see, resembling a head flanked by two shoulders. This pattern is completed when the price falls below the neckline. Okay, Uh, Before we get through the details, let's just conclude this slide and in this way. As we analyze these patterns on the charts, remember that while they are reliable indicators, they should be used in conjunction with other forms of analysis to validate trade signals. Okay, let's break down this pattern, the uh, head and shoulders, understanding its significance and see how it can be applied in trading. Firstly, the head and shoulders pattern recognized as a reversal pattern, usually forming after a notable uptrend, as signifies the exhaustion of the current trend and a potential shift in market sentiment. This pattern is composed of three peaks, as I mentioned earlier, two smaller ones at the sides, which are the shoulders, left shoulder and right shoulder, and a larger central peak known as the head. The unique structure of these peaks is a visual representation of the market's shifting dynamics. The neckline is the critical component of this pattern. It's a support line drawn by connecting the lowest points of the two bottoms between the tops. The first market bottom comes from the left shoulder, and the next one comes from the uh, head, something between head and right shoulder. And by connecting these together, we get the neckline. Okay, the neckline serves as a confirmation line. A decisive break below this line is what traders look for to confirm the pattern and anticipate a trend reversal. Now, why is this pattern significant? In the initial phase, as the market is trending upwards, the first shoulder forms, followed by a slight retracement, then a surge in buying pressure leads to the formation of the head. However, the surge is short-lived and the market fails to sustain this peak, leading to the formation of the second shoulder. And this indicates that the buyers are losing control and the sellers are starting to dominate. Uh, it signals a shift from a bullish to a bearish trend. When it comes to target projections, we use the pattern itself to estimate the potential downward move by measuring the vertical distance from the top of the head here to the neckline. We get a sense of how far the price might decline after breaking below the neckline. This measurement is then used to set a target for the trade, like you see as we call it price projection. In terms of trading setup, once we identify a complete head and shoulders pattern, we wait for the price to break below the neckline. This breakout is our entry signal. However, risk management is crucial. A stop loss is typically placed above the outer peak or the head, just depending on your risk tolerance. The take profit level is set at the target projection, somewhere near here, calculated earlier from the head to the neckline, as you see on my slide. To put this into perspective, let's consider a real-world forex market chart where a head and shoulder pattern is formed. Yeah, this is what you can see. This is a real chart at GBP USD 1 minute chart, and you see the formation of the left shoulder and the surge of the price to form the higher peak or higher market top at this level, but then losing the momentum by failing reaching the previous top and forming the right shoulder here. And then by connecting somehow the close prices is a way, or maybe you want to use the lowest, but because of this shadow, I just I prefer to draw my neckline by connecting these two bottoms to the close of the second bottom. Here, you see we can draw the neckline here, and then breaking the neckline is confirmed by closing the candle, the second candle below the neckline, and then we can project the uh, next move by calculating or measuring the distance from the head to the neckline and project it downward, and we can get this here. And you see on the RSI also we have a similar, let's say, correction round by falling from the overbought area to the neutral area and then coming up a bit and then continue downward, signaling that sellers are in control of the market. As you see, we usually have another confirmation on the chart as a moving average. I used here as WMA 100 period moving average, and you see it's nicely reacted to the price. First, when sellers kept the price down to this level, we see a very nice reaction and rebound from this level. But at the second attempt, they, let's say, succeeded to close below or cross below the moving average. And that's another bearish signal for us that we can use as a confirmation. So in this section, we will delve into the various forms of the head and shoulders pattern, because in real world, you can't expect to see things in a very perfect model, each with its unique characteristics and implications. The classic head and shoulders that we discussed is a well-known bearish reversal indicator that forms at the end of an uptrend. Okay, but first, the inverse head and shoulders, that we will explain it later, by the appears during a downtrend. This bullish reversal pattern is essentially the classic pattern flipped upside down with two lower shoulders and a deeper central, let's say, throw forming the head. And next is the complex head and shoulders pattern, you see, which is a more intricate formation. It may feature multiple shoulders or heads, indicating a stronger and more prolonged market reversal. Another variation is a symmetric head and shoulders pattern, where the shoulders or heads are not symmetrically aligned. While it's a reliable indicator, this pattern requires more careful analysis due to its uneven structure. It can result in ascending neckline right here, as you see in my slide, or maybe a descending neckline, because you can't get the almost matching two bottoms to have a symmetrical pattern. So in that case, you need to take a look at the other indicators to confirm the reverse of the prior trend. Maybe sometimes maybe you see the higher top here, or maybe a lower top, and you may not see an even shoulders on the both sides. And that's something that then you need to look at the volume if you trade stocks, or you need to check the momentum oscillators like stochastic or RSI if you are trading FX markets. So these are the variations of head and shoulders. Now, let's delve into the mechanics of the double top pattern and pivotal chart formation that signals a potential bearish reversal in the first market. The double top is easily recognizable by its two peaks, which are at or near the same price level. This is a left top and this is a right top, and they have all, somehow a matching high. And these peaks act as a testament to the price's inability to break through a significant resistance level, suggesting that the bullish forces are waning. The formation of this pattern starts with the first peak or first top, which comes after a strong upward trend, hitting a resistance point that the market struggles to overcome. Following this, we see a retracement. Somehow, like this, we see a retracement, or let's say formation of a market bottom, where the price pulls back only to rally again to the resistance level, forming the second peak or second market top. It is at this juncture that the market is retesting its previous high, and the inability to push higher confirms the double top pattern. For traders, the confirmation of this pattern is crucial. It is marked by the price closing below the neckline, the supports level connecting the low points between the two peaks. Okay, a break below this level signals that the market may be transitioning from an uptrend to a downtrend, or completely shifting the market sentiment. In terms of trade execution, the conservative approach is to wait for a candle first to close below the neckline before entering a trade. A stop loss can be placed just above the peaks to protect against false breakouts, somewhere here. And to manage risk effectively, for setting a take profit goal, we often measure the distance from the neckline to the peaks and project this distance downward from the breakout point. And it can get us this price projection level here. Okay, so this provides a quantitative target for the potential downward move following the pattern's confirmation. But when does this pattern tell us about market? Or let's say, what does this pattern tell us about market psychology? The double top is a clear indication of buying exhaustion. The first peak, as you see, represents the last breath of the bullish run, where buyers managed to push prices to a new high. However, after the retracement, the second attempt to rally lacks in momentum, reflecting a weakening in buyer enthusiasm and a rise in selling pressure. When prices fail to breach the highs set by the first top, it becomes apparent that the market sentiment is changing. This shift is significant. It represents a collective agreement among market participants that assets may be overvalued at this resistance level, triggering a sell-off as traders attempt to capitalize on the anticipated decline. And remember, the double top pattern is a tool, not a rule. It suggests a high probability of a trend reversal, but should not be used in isolation. Wise traders corroborate this signal with other indicators and market analysis to ensure that the double top pattern aligns with broader market conditions. As you encounter double top pattern in your trading, respect the signal it provides, but also maintain discipline in your analysis and execution. This pattern is a powerful indicator of potential market reversals and can lead to rewarding trading opportunities when interpreted correctly and used as part of a, let's say, comprehensive trading strategy. Then let's take a closer look at triple tops. Triple tops is very similar to head and shoulders, and only difference is that the second top is not considerably higher than the other two tops. Instead, it stands almost at the same level. And this pattern is also suggesting some range-bound trading at the end of an uptrend that signals the prior uptrend is out of steam. And if and only if the neckline gets broken in a persistent manner, we can conclude a probable reversal to the downside. Also note that the neckline here is more significant support level compared to double top, as we see more touches, one extra touches we see here. So we can expect a sharper consequence move if the market violates the neckline support level. The target projection is the same as head and shoulders and the other reversal patterns. You can just measure the distance from the top to the neckline or the bottom, and then you can project the price downside. In terms of trade execution, the conservative approach is to wait for a candle to close below the neckline before entering a trade. Again, a stop loss can be placed just above the peaks to protect against false breakouts. And to manage risk effectively, for setting a take profit goal, we often measure the distance, as said, from the neckline to the peaks and project this distance downward from the breakout point. This provides a quantitative target for the potential downward move following the pattern's confirmation. And here is another exciting bearish reversal pattern. In the realm of forex trading, the failure swing pattern stands out as an essential early warning indicator of a potential reversal. Unlike other patterns that may provide confirmation after the trend has changed, the failure swing gives traders a let's say preemptive signal that can be crucial for timing the market. This pattern comes into play when we see a shift into a typical rhythm of an uptrend. In a healthy uptrend, we expect to see a series of higher highs and higher lows. Okay. However, the failure swing pattern is characterized by a deviation from this pattern, especially the formation of a lower top. This is our first clue that the bullish momentum is waning and the grip of the buyers may be loosening. As traders, we look for evidence to confirm our suspicions that the trend may be reversing. And this confirmation comes when the price breaks below the last significant bottom. We call it the neckline here. By the way, it's not just a minor dip, it's a decisive move that undercuts the previous low, challenging the very definition of an uptrend. To add an additional layer of confirmation, we often turn to the RSI. During a failure swing, you might notice a divergence or divergence. The price records a lower top while the RSI fails and makes a new high. And this lack of confirmation from the RSI is a powerful signal that the bears can gain in ground. The final nail in the coffin is when the RSI also rigs below a key support level, often aligning with the prices break below the last low. What makes the failure swing pattern particularly appealing is its simplicity and clarity. It's easily recognizable and straightforward to trade, which is why it is favored by many traders, both experienced and novice. The clear price action allows for objective decision making, free from the often complex interpretations required by more subjective patterns. Furthermore, the failure swing pattern encompasses all the features needed to measure reliable reversal. It appears at the ends of an uptrend, not somewhere in the middle, which is crucial for identifying true reversals. The failure to make a higher top is a clear indication that the buying momentum is fading. And most importantly, by closing below the last significant bottom, it provides concrete evidence that the market direction is turning, validating the previous uptrend's definition. So the combination of these factors, loss of momentum, failure to create new highs, and a decisive close below the last low makes the failure swing pattern a compelling signal for reversals. It offers traders a chance to get out of the market entering or exiting positions before most traditional signals would prompt action. In conclusion, the failure swing pattern is a powerful tool in forex trading. It's not just another indicator, it's a let's say, a comprehensive signal that draws price action and momentum to provide an early alert to trend changes. Recognizing and understanding how to trade these patterns can be a significant advantage in the fast-moving forex market. And here you see a real let's say a real example of the double top pattern, I guess. Yeah, this is the double top pattern, and somehow it can, let's say, it can be interpreted as a failure swing because the most common challenge in recognizing double top patterns is that we usually can't find a matching high, the exact matching highs or market tops. However, we can accept any approximate closing near the previous market top, something like this. And when it comes to understanding a pattern like a failure swing, now that can make it very easy for us to understand the reversal, because the important thing is that we don't want to miss any trade opportunity, of course. Yes. So what you see here is that the market came to this top and then failed to reach it again by forming or creating this lower top here, and then we can consider a neckline around this area. I took the middle of the shadow somehow to get my neckline, because if I wanted to put it on a close price, it might be a very early signal, not so I won't be so confident to trade it. And if I wanted to put it at the end of the shadow, the lowest level, which is technically this is the bottom of the market, but I consider it to be a bit late to enter the market because the long shadows usually represent the buying pressure in the market, and this is a signal of rejecting the lower prices. And also we have our WMA 100 here, and you see a very nice reaction to this level, and then we bounced back to the new lower top, and then we eventually just broke below the neckline. This is a signal we can project our price here. And if you consider the RSI, you also see that the RSI, after reaching the overbought area, is coming down in a downward move. And when it comes to breaking below the neckline, we see the RSI is completely in a selling zone, confirming our trading setup of sell position setup. Okay. Okay, guys, how's it so far? If you have any question, please write it down in the chat box. I would be more than happy to answer if I know. Very good. Okay, So let's move forward in our journey through the landscape of technical analysis. We come across several chart formations and signal potential for bullish reversals here. These patterns are crucial as well for traders looking to capitalize on early signs of an uptrend. Today we will discuss some of these most famous bullish reversal patterns, the reverse head and shoulders, double bottom, triple bottom, and bullish failure swing. Bullish reversal patterns typically form after a downtrend and indicate that the selling pressure is exhausting and a reversal to an uptrend is imminent. Common feature among these patterns include a decline to support level, a bounce, a retest of the support level, and a subsequent breakout indicating a shift in market sentiment from bearish to bullish. The reverse head and shoulders pattern is the bullish counterpart to the classic bearish pattern. It's characterized by three uh, bottoms, with the middle bottom being the deepest, resembling an upside down head flanked by two shallower shoulders. Okay, a neckline is drawn across the high of the two rebounds. The pattern is confirmed when the price breaks above this neckline, suggesting a strong potential for an upward price movement. And then the double bottom we see, the double bottom pattern is another powerful bullish reversal signal. It resembles the letter W, if you see, with two consecutive uh, bottoms at a similar level and a top in between. The breakout point is when the price moves above the resistance level, confirming the reversal. Then we see the triple bottom patterns extend the double bottom with an additional bottom, creating three distinct lows at a similar level, or let's say almost similar level. This pattern shows a strong level of support and an even more significant potential for an upward reversal once the price breaches the resistance level after the third bottom. Lastly, the bullish failure swing is identified by the price making a lower low within a downtrend and failing to make a new lower low and instead breaking above a previous high. This pattern suggests that sellers are losing control and buyers are gaining strength often before the change is visibly clear in the price action itself. Okay, very well. Now, let's address why this pattern is so significant before we jump on the trading setup of these patterns. Each of these formations tells the story of a struggle between buyers and sellers. After a period of declining prices, we know the market finds a support level that the sellers can't push through, and this support level tested multiple times in the case of the double and triple bottoms becomes a foundation for the new trend. When the price finally breaks out from these patterns, it's a sign that the buyers have taken control and trade, and there is a strong likelihood of a continued upward trend. Traders anticipate these breakouts and may use them as signals to enter long positions. So it's very important to know that volume often plays a key role in confirming these patterns. An increase in volume, not in forex but in a stock trading, uh, on the breakout provides additional confirmation that the pattern is valid and the reversal is likely to sustain. In conclusion, understanding these bullish reversal patterns can give traders a significant advantage in identifying potential opportunities for entering long positions. Recognizing the shift in momentum from bearish to bullish and acting upon the breakout can be a powerful strategy in the forex market. So let's consider the aspect of target projections. These bullish reversal patterns, like their bearish counterparts, target projections in bullish patterns, are based on the measured move principle. This technique involves calculating the potential upward move by measuring the distance of the pattern itself. As you see here, for instance, in the reversed head and shoulders pattern, we measure from the bottom of the head, the deepest bottom here, up to the neckline, and after a breakout above the neckline, this distance is then projected upward to determine the minimum expected rise. And here you can see, let's say, a real example. You see, this is our left shoulder. We need a downward movement or a downtrend, and then you see our left shoulder here. The market topped here and then deeper falling to this level made this head bottom, and then some positive correction took the price to the new market top, but it's lower than the previous one. As a result, we see a somehow descending neckline formed here. And then we see our next shoulder, the right shoulder, and a breach above the neckline is a confirmation of completion of the head and shoulders pattern, this reverse head and shoulders pattern. Then we are able to project our targets equal to distance between the last top, the bottom of the head and the neckline to the upside. And then you see eventually price hit this level. And here is also another example. You see, this is a bit more complicated setup on a real chart of GBP USD. You see the first shoulder here, or the left shoulder here, is somehow among a very fluctuating candles, not very clear, but eventually we can consider it as the left shoulder, and then we topped here, and then this is our head because we have the deepest market bottom at this level, and then the buyers try to form a higher low or higher bottom here by forming this doji candlestick, and then eventually a break above the neckline, which is resulted from connecting the two tops that we have from the shoulders, then breaking above this neckline leads the price toward the price projection, which we discussed earlier. And similarly, in the double bottom pattern, the distance from the bottom of the W to the resistance level, essentially the middle peak, gives us a minimum expected rise once the breakout occurs. This distance can be projected upward from the resistance level, offering a price target at this level for the, let's say, ensuing uptrend. And here is an example. You see, it took many candles to form the first market bottom here, but then we have a very sharp bottom here. We call it Adam and Eve pattern, double bottom pattern. By the way, don't confuse yourself with these terminologies. Just look at the RSI and look at the pattern. We have the approximately same lows here, and then a break above the last top lead to a price projection, which is equal to the distance from the top to the last bottom. And if you see, the RSI has formed also a very nice reversal pattern, backing all the way up from the oversold area to the overbought area at the point that we meet the price projection. The triple bottom follows the same logic, with the targets being set above the resistance level by the height of the formation. And here is another real example. I brought it here on a purpose because I wanted to show you that don't expect that always you see the exact symmetrical tops when you are looking for a reversal formation. The important component here is having almost approximately matching lows or market bottoms is very crucial. But just leave the tops alone, because in that case, you might, to project your price, you might consider the latest market top, or you can go more aggressive by considering the highest market top, as what we did here. And you see, and based on that, we projected the price upward to this level. And the confirmation here is breaking the neckline. And all the examples I showed you saw moving averages play a vital role in providing a clear confirmation about the completion of each of these, let's say, reversal patterns. Okay. And for the bullish failure swing after the initial lower low, once the price breaks above the previous high, we can project the expected rise by measuring the distance from the low to the breakout point, just as we explained in the opposite direction for the bearish failure swing. And based on that, you can just project your price. Very well. Okay. As we reach the conclusion of today's webinar, let's encapsulate the critical role that chart patterns play in the art of trading. These patterns are not just lines and shapes on the chart. They are the footprints of market psychology and sentiment, offering a strategic edge to those who know how to interpret them. Firstly, let's consider the development of trading strategy. Incorporating chart patterns into your trading strategy can significantly enhance its effectiveness, and these patterns can provide entry and exit signals, helping to define clear trading scenarios. Whether you are a day trader, swing trader, or long-term investor, chart patterns can add depth to your analysis and help you understand when the market might be shifting in your favor. Moving on to predicting price behavior, chart patterns are invaluable for estimating the future direction of price movements. They are considered a leading indicator, often showing where the price is likely to go next. By identifying patterns early, traders can set price goals and adjust their strategies accordingly, staying one step ahead of the market. Measuring trend strength is another vital aspect. Chart patterns reflect the strength or weakness of a trend. For instance, a consolidation pattern following a strong move might suggest that the trend is losing momentum and could be nearing an end. Understanding this can prevent traders from entering late into a trend or holding onto positions that are likely to reverse. Lastly, risk management is perhaps the most crucial aspect for chart patterns prove their worth. The identification of these patterns helps traders set logical stop loss levels, protecting their capital from unexpected market moves, and They also provide objective targets for taking profits, allowing traders to lock in gains and manage their risk to reward ratio effectively. Recognizing these patterns enables traders to create a more structured approach to managing market risk, aligning their strategies with the prevailing market conditions. In a sense, chart patterns serve as a nexus between our analysis and action. They guide us through the noise of market fluctuations, offering a clearer perspective on potential market movements. By integrating chart patterns into our trading journey, we harness the collective behavior of market participants, translating it into actionable insights that can lead to informed and disciplined trading decisions. As we wrap up, remember it's while patterns are powerful tools, they should be used in conjunction with other forms of analysis and market understanding. It's the combination of tools and knowledge that creates a robust trading approach, and chart patterns are a fundamental part of this mix. Thank you for joining this webinar as you move forward in your trading journey. I let the insights from chart patterns illuminate your path to a strategic decision making and market session. Thank you so much. I hope to see you all in our upcoming webinars. Thank you. Take care.